Welcome to the Corporate Knights Online Roundtable, Global Sick Leave 2020. My name is Toby Heaps, and I'm the CEO of Corporate Knights, and it's my pleasure to welcome you here today. When the COVID initially hit the industrialized world earlier this spring, we, like many people in the sustainability community, were asking what it means for us and what it meant for us as a global research and ratings firm that looks at 8,000 companies globally and rates them on various sustainability factors, social and environmental, is it meant that we had a huge blind spot. None of our indicators really gave great insight into the preparedness for large global companies to deal with the challenges and the threats of COVID. And so we looked at some of our peers. There's much good work being done, including by Just Capital. And we identified about 12 metrics that we thought would give some insight into how prepared companies were, large global companies were, to deal with the COVID crisis and be prepared for it. And as is the case with most sustainability themes, you often can find out more with less in terms of having a tighter focus. And as we went through the indicators, we were looking for an indicator that would be meaningful, an indicator that would be hard to fudge, and an indicator that would have a high correlation with other types of measures that tend to go along with companies that are more prepared for an era in which we have more zoonotic diseases, we have more flus, more influenzas, and the intensity of these and the severity of these and the frequencies of these viruses appears to be rising. So it's something that is critical from a human capital preservation perspective. And so we, having gone through all the indicators, we landed on having a paid sick leave policy, which is so critical because so many people are having such a hard time making ends meet. If they don't feel secure when they feel a little bit under the weather and like they might have COVID-19, if they don't feel secure in taking the time off, especially for workplaces where you're an essential worker and it's not as much of a luxury as for the white collar workforce who can work from home. If they don't feel secure, then often they have to make a choice between getting their paycheck and then or putting their or not getting a paycheck. And if they're getting a paycheck, sometimes they have to put their life on the line. So having a paid sick leave policy and the global sort of threshold of having it at 10 days annually for full-time employees to have the paid sick leave policy was a threshold that we identified as being pretty critical. And so we're going to give you a little bit more information about how we went and assessed this, what we found out. But the big takeaway is that while many governments have made this the law of the land, some substantial governments, including in North America, for most employees in Canada and in the US, this is not the law of the land. But there are many leading companies in every sector that have voluntarily implemented these measures because they recognize the sound business case for doing it. And there are many companies in every sector who have not. So this is a really ripe area for responsible investors to dig into and see what is inside their portfolio. So it's my pleasure to be able to co-present this report with my colleagues. We have with us Theresa Gusman from First Affirmative, which is one of the leading networks for responsible investment advisors in the US with over $1 billion in AUM. We have Bill Davis, who's the managing director at Stance Capital. And Bill has been running a strategy that is top ranked by Morningstar that merges the best of fundamental quantitative analysis with sustainability analysis. And I should disclose that Corporate Knights works together with both Bill and Theresa in terms of the data provision. And Bill's strategy has been highly successful from a financial perspective and also delivering superior impact in the large cap US value space and with some other areas to be tackled, but a good strong track record that proves the thesis that sound integration of sustainability fundamentals and financial fundamentals can lead to outperformance. And then we also have with me my colleague at Corporate Knights, Väyrynen, who did the heavy lifting on this research report and will be sharing the findings of the research report. So I'd like to turn it over to Laura to give you a tour of the research report, and like to remind everybody that you're welcome to ask questions in the Q&A. There's a chat function as well, but if you could put your questions in the Q&A. Is a housekeeping matter too, just to note The report is live now on corporatenights.com, accompanied with an article. The report includes a great foreword from Bill and Theresa. And we hope, our intent and our hope with this report is that it can serve as a useful tool, and the data can serve as a useful tool for the investor community to engage with companies, to help them along the way to ensure that they have a really resilient human capital policies in place when it comes to paid sick leave, which is Laura will shed some light, is in their financial interest, in the investors' financial interest, and in society's collective interest, so that we can be more resilient and be able to bounce back better after this. So without further ado, I'll pass it over to Laura. Laura?
Thank you, Toby. So just to give a quick overview about Corporate Knights. So Corporate Knights' mission is to provide information that empowers people to harness markets for a better world. We have a media division and a research division. The media division manages our award-winning business and society magazine, Corporate Knights, and our website, corporatenights.com. The research division, we produce corporate rankings, research reports, and financial product ratings based on corporate sustainability performance. And as Toby mentioned, we would like to thank our partners in this project. So first, Affirmative, represented today by Theresa, and Stance Capital, represented today by Bill Davis. So just to start by going over the methodology of a report. So our goal for this report was to assess the extent of paid sick leave policies in the largest companies in the world in the wake of COVID-19. We researched 856 public companies. This list of companies was compiled from 3 different groups: the 500 largest publicly traded companies globally, the 500 largest companies in the United States, and the TSX 60. We looked at 2 types of sick leave, so standard sick leave policies and any new policies that have been implemented due to COVID-19. Because many of these companies operate in several countries, we chose to look at 2 countries for each company: their headquarter country and the country where they generate the most revenue from, which we will call the secondary country. So naturally, a company merely having a sick leave policy doesn't necessarily mean that the policy is a good policy. For example, some companies offer only 1 or 2 days of sick leave per year. So based on the research we did, we determined what would count as sufficient paid sick leave days in this research. For traditional systems with sick leave days and vacation days in 2 different buckets, we determined that 10 sick leave days per year was sufficient. For companies that use paid time off or PTO systems, we decided that 20 days would be sufficient, considering that good employers give both sick days and vacation days. And lastly, if a company had a short-term disability support program, 5 days was deemed as a sufficient number of paid sick leave days, as long as the support starts immediately after the 5 days. And to confirm, all of these days need to be paid. We looked at data from 4 different sources, and we gave all companies the opportunity to verify the data by contacting them. The companies were also ranked, assigning each company a score and a color label. We'll get into those in a few minutes. This information is also available for investors for a fee. If you're interested, please feel free to contact us at Corporate Knights. So in this key findings slide, we'll highlight 6 figures that capture the key things of our findings. Just as a note, all the numbers we present are only numbers pertaining to the headquarter country, unless otherwise mentioned. So 41% of companies offer sufficient days of paid sick leave per year in their headquarter country. This includes companies that comply with national legislation and those that have company originating policies. 30% of companies offer sufficient paid sick leave in both their headquarter country and their secondary country. The median number of paid sick leave days was 6.0, and the median number of PTO days was 18. So both medians are below the Corporate Knights sufficiency standards. In terms of COVID, 10% of the companies we looked at implemented COVID-specific sick leave, and the median number of COVID-related sick days was 14.0. So on the right side of the screen, you can see a table with an overview of the existence of policies in companies in both countries with legislative requirements and in countries without legislative requirements. You can see that when you look at both countries, 41% of companies offer sufficient paid sick leave, so the 40.9% cell in the upper right corner. However, when you exclude companies in countries with legislative requirements from the calculations and only look at companies that are responsible for their own policies, the number of companies with sufficient paid sick leave falls to 18.9%. The disclosure rate also decreases significantly when only looking at companies in countries without legislative requirements, with over half of companies not disclosing any information on their policies. The bottom line is that if there is no national sufficient sick leave legislation, companies are unlikely to provide it. This should be an important thing for policymakers to remember. Next, we'll look at country-specific statistics. So the company universe we researched included companies operating in 43 different jurisdictions, and 31 of those had sufficient national sick leave policies according to the thresholds I mentioned earlier. 27% of all companies in the universe were headquartered in countries with sufficient policies. 58% of companies in the universe were headquartered in the United States, which is one of the 3 most represented countries in the universe that didn't have sufficient national paid sick leave. Other countries like this included Canada and Japan. And as you can see, 28% of Canadian companies had sufficient paid sick leave, compared to under 20% in the United States and Japan. So now we'll take a look at industry-specific numbers. Please note that here we only looked at company originating policies, not national policies. So the IT sector has the largest percentage of companies offering sufficient paid sick leave, 39%. The average number of paid sick leave days in the sector was 12.8, compared to the overall average of 10.3. The healthcare sector and the communications sector followed IT with around 30%. The worst performers in terms of industry were the consumer discretionary industry and the industrial sector. So when COVID-19 intensified last spring, lots of companies came under pressure to offer extended sick leave policies to both promote the health of their employees and also to slow the spread of the pandemic. However, based on our research, 10% of companies implemented some type of additional COVID sick leave. Nearly all of these were more than 10 days in length. And the average number of COVID-related paid sick leave days was 14.4. And companies headquartered in Canada and the UK really led the way in implementing COVID leave policies, with 15% of companies in both countries implementing them. In terms of sectors, communications and financial sectors were the leaders with around 13% of companies in each sector implementing COVID leave policies. And to wrap up, here's an overview of how we labeled companies based on the extent of their policies. We divided all the companies into 4 categories: red, yellow, green, and gray. Red companies didn't have a sufficient policy in either country. Yellow companies had a sufficient policy in one country, but not the other. Green companies had a sufficient policy in both countries. Gray companies didn't have any data available or didn't provide any additional data for either country. A more specific list with a label and score for each company is available to investors, as mentioned earlier. As you can see, 1/3 of companies had a sufficient policy in both of their countries, which is great news. However, 15% had no sufficient policies. Of course, this number is too high. However, I would really like to draw attention to the fact that 1/3 of companies that were labeled as gray. This means that they didn't provide any public information on their sick leave policies and did not provide corporate knights with information about them when contacted. We hope that due to increased pressure on companies to ensure employee health and to disclose their efforts, that this number will be lower in the future. So thank you so much for your time and attention. You can go download the report on our website right away, and we welcome any questions. And you can also contact us for any inquiries through the email addresses on the screen. Thank you.
Thanks, Laura. That was a great tour. And it's one of the things interesting is to see how many companies who didn't have policies were able to react just in a matter of months and implement policies, particularly the number of companies in the US, where I think there was the number of companies that had a paid sick leave policy increased by half during COVID, most of those policies still being temporary. But that just shows how quickly things can move, and we're living in this sort of time where the Overton window of what's possible in the mainstream, of big things that are possible in the mainstream, has kind of went from this wide to this wide, and many things that were not possible or would take 3 or 4 years of study to implement now can happen much more quickly. So I think that's on an optimistic note that provides some hope for closing these gaps that we see and getting more resilient companies. The next part of this online roundtable is going to be a discussion. And initially, we're going to draw in Bill and Theresa. And it's a sort of a bigger discussion on the human capital and COVID in the context of being a sustainable investor from the advisor and from the portfolio manager side. But maybe quickly, just before we get into that, Bill and then Theresa, do you have any quick reactions from what you've just seen from Laura?
Yeah, sure. And I want to start by, Toby, thanking both you and Laura, because I think that this is critically important work. I think maybe this began in a conversation that you and I had, I think sometime early summer. You know, my big question was from a portfolio manager's perspective, what lessons can we take from this to build portfolios that are more resilient? And that's really, I think, how this started off. And a couple of things came out of that, both relating to human capital. I think one of my key takeaways from this, which is maybe stating the obvious, but there's a big difference between having a job and having a good job as it relates to livability. And I think, Laura, I can't remember if you mentioned this, but I read this in the report itself, that only 30%, the lowest earning 10% of wage earners in the United States, only 31% of those have paid sick leave, compared with the top quarter, where 92% have paid sick leave. So there's a huge difference, not just between companies, but there's a big difference even within companies. And of course, the problem around all of this relating to resiliency is what happens with the lowest wage earners, who are the most vulnerable already, become even more vulnerable. If they can't afford not to work, they continue to work, they affect everybody else in the organization, and it just has a spillover effect. So that was one of the key takeaways. I mean, there's other data that I want to dive into and implications of it, but I'll stop there. And Theresa, what do you think?
So I agree with all of the things Bill just said. I think one of the key takeaways from this research is that there are concrete metrics that you can use to look at human capital and how companies are treating that human capital. And to me, one of the key issues that's been sort of holding back the incorporation of social and human capital issues into ESG related scores is just the absence of data. And this is a great start in collecting data that is not related to, simply counting the number of women on a board or looking at the diversity in a company, but looking across all the employees in that company and saying, well, what is your sick leave policy? I think the next step here, and this was, goes along with what Bill was saying, is to look at the differences in sick leave policy from the top of the organization to the people that are on the factory floor or the people that are working in the restaurant or whatever. But there are probably some very significant difference is there in the benefits offered to those people. And I think the next step is to go deeper there. But to me, one of the missing elements in looking at human capital, we've gone a long way in looking at environmental impacts, but we haven't gotten there in human capital. And that's the next frontier as far as we at First Affirmative are concerned, in terms of where do you go next with your ESG metrics.
Thanks, Theresa. On the human capital side, Bill, how at Stance, how do you incorporate human capital factors currently into your portfolio management process and engagement process?
Sure. So I think we track something like 21 key performance indicators in all right now, and then additional red flag exclusion screens. And between them, I would say human capital is decently represented, but as Theresa says, it's really sort of underdeveloped. And so, you know, for example, we track gender diversity, both in management and at the board level. We track injuries and fatalities. We look at human rights violations, and we track compensation ratios. But, you know, that's kind of like broadly, it's at a corporate level. It doesn't get to the differences between working on the loading dock and working in senior management. And of course, that's where this all needs to go. And so I agree entirely with what Theresa says. As ESG investors, we have been so focused on climate risk, right, that it's easy to kind of gravitate towards the E and the G. And then all of a sudden a pandemic that comes along that is completely related to and a part of climate risk. And yet there's really sort of nothing in the screens and filters that enabled us to build portfolios to be resilient around it is it's a glaring, I think, deficiency. Now, on the other hand, the good news is the great thing about ESG factors is that they are alive, right? And what's important now might diminish the importance of something from 3 years ago. And these can evolve, and ultimately they are persuasive, right? They're either persuasive in terms of financial performance, or they're persuasive in terms of social implications, which, you know, we could have a whole conversation about how that also ultimately links to financial performance. But, so I think that, one of the things that's exciting to me is this is going to be a KPI for us moving forward. And ultimately, as more and more investors and other members of the ecosystem get involved, it'll cause that gray area, Laura, where, a third of all companies, or 40% or whatever the number was, don't report anything. They're not going to have places to hide, because as more and more ecosystem stakeholders, put pressure on corporations, the transparency will emerge. That's
interesting. And I'm thinking about Theresa's point too, just about, especially when you look at temporary workers and some of this sort of the Uberification of the economy. I think Uber was one of the companies that we took a look at, and it was good at the head office side for paid sick leave, but obviously their drivers have a bit of a different experience. And one of the things we've noticed in getting the data, and other research agencies are wrapping their heads around this too, is there's quite a number of companies who report human capital metrics for a pretty narrow scope, and then there are a leading number of companies who report it for a complete scope. So you'll have some companies reporting injuries, but it's just for their kind of, their headquarter country. It doesn't include their major operations in, say, China or contract workers. You have a lot of companies reporting fatalities, but not including the fatalities of the contract workers, where some of the good reporters are including it. And so getting really specific about, in the questions when they're going out to companies, to get them to sign off on if this number is for injuries or for fatalities or for benefits like paid sick leave, is this applying to all full-time and temporary workers and contractors, and is it applying to all major operations and countries? And I think it would be nice to get to that scope where you can find out what percent it's applying to if it's not all. And some companies are able to provide that, but even at that binary level, then better comparisons can be made, and at least we can sort of put that box of complete reporters to incomplete reporters. This is a huge area, not just for the human capital, but also for the sort of environmental resource indicators. We have many companies who are not reporting the energy or the greenhouse gases for all of their operations, even in sort of, in the oil or energy or utility industries, that you would expect that to be there. So really kind of getting an idea about the sort of the quarter of companies of reporters who are doing a great job doing complete reporting, and making sure they're not being compared against the garbage reporters, because they end up looking worse. If you're reporting for your contractors on fatalities, you're reporting for all your countries and operations on your greenhouse gases or on your injuries, you will look poor in comparison to your peers who may just be reporting their headquarter country. So really kind of getting that bifurcated into the complete incomplete reporters. That's something that we're really focused on this year, and we know a lot of other folks in the community are, to get that sort of more quality kind of comparisons. Theresa, you talked a little bit about some of these blind spots on the human capital side. I wonder if you might be able to go into, maybe share a little bit more for us in terms of what you, when some of the things you're looking at, but some of the things you don't see that you think would be useful to have more light on with respect to human capital performance of companies that are evaluated in your network and your tool, which is a pretty impressive tool that enables advisors to create portfolios that are more aligned with their clients' values.
Yeah, I'm just going to, if you don't mind, Toby, just pick up on one of the points that Bill was making and just take it to a sort of a different level.
Yeah.
One of the ways that we interact with companies is through our corporate actions, engagement, and proxy voting policies. And that type of engagement has really, over the past several years, been focused almost solely on climate-related issues and environmental issues. And what we're doing now is engaging and really targeting 9 major companies and gathering specific information on workplace equality. And this is gathering information like workplace diversity, gender and racial pay gaps, freedom of association, and other topics that factor into this. And these are difficult things to sort of count, so they're difficult to attach metrics to. But what we're doing is working with other managers who are involved in corporate actions and really focusing on these issues. And our hope is that doing that will allow us to drive that to the point of more adequate reporting than what we've gotten to date, and as adequate as what we're now starting to get. And I say starting and emphasize that on climate-related issues. There are other initiatives that we're working on, of course, but really the focus is going to shift really toward more of those social issues. And COVID has really pushed the initiatives in that direction. So just to go back to the question now that you just asked me, Toby, I think you know that we build custom sustainable investment solutions on our new advisor workstation. It's called Affirmative ESG, and it allows clients to incorporate their own personal values, beliefs, social and environmental preferences into their portfolios. And we have a number of preferences that are related to workplace issues. And those include board diversity, best places to work, worker health and safety, as Bill mentioned. But the things that are sort of lacking really right now are in paid sick leave policy and things like that. So we have already started parsing the data that we've gotten from Corporate Knights. We're really fortunate to be one of their clients, so we have that data now, and we will incorporate that data into our impact preferences, particularly looking at things like rapid COVID response, because generally the better companies will have that type of response really quickly. And at the other end of the spectrum, we will incorporate a category that focuses on companies with 0 paid sick leave days, because that is a completely unacceptable policy. And eventually, with worker satisfaction being a key indicator of worker productivity, if you're not paying people while they're sick to stay home in this environment in particular, that's a really big red flag as far as we're concerned.
That's really helpful and interesting to know that the study with the 9 major companies on the gender racial pay gaps and the freedom of association and the workplace equity issues, I think a lot of that sounds like a really impactful project. And I think, just in terms of honing in on those zero paid sick leave days companies, pretty good place to start for conversation. I'm not sure how that can be justified even in a sort of actuarial environment. Bill, when the pandemic hit, and by the way, thank you for sort of planting the seed that led to this project, and a good part of Laura's summer and some of our other research team going through all these companies.
Well, that's good. I have some other seeds I can plant as well then.
One a season probably is perfect. So when the pandemic hit, you were thinking about a lot of things, and I wonder if you might be able to share with the audience what it made you think about in terms of other human capital risks, social issues that businesses really are being pressed to deal with, and that this is sort of something that has become more top of mind, revealed by the time and the pressures of COVID.
Yeah, sure. So I think sort of an obvious partner to paid sick leave is living wages, which is a huge issue in a lot of industries, and specifically in service industries. Theresa touched on this. I think that racial injustice and just social equity in general is become a huge issue, and it's become an issue, I think, because corporations now, especially the ones that are more forward leaning and are thinking sort of beyond the next quarter's returns, are understanding that it's not in their best long-term interest to have so much inequity in our country, because it's not healthy from an economic standpoint. It leads to all kinds of other spillover problems, and are now trying to figure out what to do about it. And this kind of gets to the heart of what we were talking about earlier, which is that it's one thing to say, okay, well, 9% of our workforce is comprised of people of color, Black, Latinx, Native American, whatever the definition is. But there's a big difference between the level of the organization where those employees reside. And so unless, like if you kind of zoom out to the SDGs for a second, and you want to have equality, and you want to have people that are paid enough, and you want to have equal opportunity, you can't do that without all kinds of things needing to be put in place. You need workforce development. You need to make a concerted effort that if you want to lift people out of poverty, that they need to have access to the high-paying jobs, the STEM jobs, the IT jobs, not the loading dock, service jobs. And therefore, corporations need to bear responsibility for that. But it starts by understanding kind of where you stand today. And so I think that, look, I'm a big believer that not every ESG factor necessarily leads to financial performance in the short run, but rather what these things do is help build a composite picture of a company that helps investors understand whether they want to invest in that company or not. And, maybe I'm spilling over into another kind of line of discussion, but ultimately I think that the social aspects of portfolio construction can be separated from the financial performance aspects, such that investors have the opportunity to outperform the market with less risk, and the values alignment in effect becomes a free option for them. And so I think that there's a whole lot of areas around social capital, and specifically I think a lot of it is around social justice and racial justice and living wages that can be teased out through the ESG process to provide investors with additional insight. As Theresa said earlier, we haven't had the benefit of having the data points, and if you don't have the data points, it's hard to do much with it. But I think that these data points are going to quickly emerge over the next year or two, and it's really kind of I suppose it's the ironic benefit of COVID that it's bringing us to this point where all of these things are now going to be important enough to pay attention to and report on.
And one other thing just on that same subject, which is, Bill alluded to this, but oftentimes women and people of color are sort of segregated within a company. So you'll find that there are certain areas within the company that are dominated by women. Operations in financial services companies, for instance. So you may have vice presidents, which is what people look at, how many VPs are female versus male, or, Caucasian versus not Caucasian. But what you're really looking at is a group of people that within that job title are segregated. And to me, you have to go down the next level and look at, really, I think compensation is a much better metric than job title when you're looking at that, because most firms report based on the title of the employee. But if you report based on the compensation level of an employee, you're going to understand just how segmented and how the workforce is divided across different compensation levels and across racial and gender lines. So I think it's really important to go that next level down. So if you want a great idea for your research, it's that type of in-depth look at workforce composition.
Yeah, that's, as both of you were talking about that, another one of the big projects that we had going was looking into the racial diversity, which is supercharged. And I think it's one of the silver linings that could be on this COVID and the tragic killing of George Floyd that really will be sort of two of the things that are there with punctuation marks for 2020 in terms of, what had impact on the global mindset. And as we were looking at this, how could you fairly look at companies' racial diversity using what information is practically available? And so there are, categorizations that can be used from different national governments. The Canadian Employment Equity Act actually is pretty good because Canada is one of the most racially diverse countries in the world, so it has some good categorizations. And then if you want to do it for a comparable peer group, as you said, Theresa, one company's a VP, one company might have 4 VPs, another company might have 400 VPs, because it doesn't mean the same thing. And so we tried to do this by title, looking for chief in the title, and we found one Brazilian large bank had 48 people with chief in their title. And so that was so as a starting point, just to look at, okay, where's the natural breakpoint on the website for the leadership executive team and for the voting members of the board of directors? Where's the natural breakpoint for the executives, sort of looking for that, kind of direct reports to the CEO, and generally sort of like more in that kind of 4 to 12 kind of members, the team, and just kind of getting insight. Okay, well, from what you can glean on publicly available sources, the bio, the photo, the name, that's not perfect. But from what you can glean from that, making an analyst assessment of what racial category, not for that to be disclosed for the individual, but just as an aggregate for the company, then you can kind of get some sense, and you can get a sense going across the board by sector and by country. You have to be careful too when you do this on a global basis. South Africa, the majority of directors are still, for the large publicly traded companies, are still white. So you don't want to penalize the company for having a black director who's trying to overcome this sort of the era of apartheid that still pervades the boardrooms there. And so coming up with a definition where you can say, well, we'll count the directors are racially diverse against the population of directors in that country for pure companies. So in South Africa, being a black director, you're not part of the majority population in the director community, and so that you can kind of get a point that counts as racially diverse, because it's making an involvement on the power structure. But these issues, they're all sort of there to be solved creatively, and at the end, I think getting the sort of regulatory guidance and accounting guidance is kind of necessary to get a complete picture for all levels of the organization, as some governments like the UK are doing, at least on gender pay equity now. So it is interesting. And on Bill's point on the living wage, I think this pandemic, for a lot of us, people that were invisible to so many people, the grocery store workers, to the Amazon delivery workers, the warehouse workers sorting through the Amazon stuff. You know, Amazon's created more jobs in warehouses than any company's created anywhere in the last few years. They might get replaced by robots in the next few years, who knows? But these are the people that sort of, you know, make our world go around. And I think a lot of people have realized that, and many of those people are struggling below living wages. And so that's something that Bill, we're really kind of taking a hard look at. How can we get a better view on that? Because that's probably the sort of, you know, biggest indicator that doesn't, and when you do that, having to get the complete scope. So you're not going to penalize a company for reporting its full workforce in all countries and operations and contractors versus the company that's not. And so really getting precision on the scope is going to be important there to be able to make good investment and engagement opportunities, move things forward. But yeah, those are both, it's listening to you both, it's giving us lots of ideas on the research side. So moving along, I guess, on to getting to our questions, we have some questions coming in we'd like to get to as well. Maybe going to you, Bill, and then Theresa. If we're specifically looking at the paid sick leave policies, what is the investment rationale for considering the adequacy of a company's paid sick leave policies?
If you believe the way we do that many ESG factors are difficult to correlate directly to performance in isolation, right? And by the way, it's also difficult to separate skill from luck in timing and other things. I think that our view is that this becomes important in terms of, as I said earlier, building a composite picture of a company. You know, companies are like human beings. There's good human beings, there's bad human beings, and then there's almost everybody else, which is either generally good that once in a while does bad things, or generally bad that confuses us by doing good things. And so I think part of ESG investing, if you can separate out how to perform from the values that you want in the companies that you're getting the performance from, which is what we do at Stance. I mean, that's, you know, we generate good performance, but we're the first to tell you that most of our performance comes from things like risk efficiency and the AI-based algorithms that we build around fundamentals, and the values alignment is really, as I said earlier, a free option. So, you know, so if you have that attitude, I think that I can rationalize today, even though, by the way, I can't prove based on a very early analysis of the data that you provided me, Laura, I can't prove that actually the companies that have more progressive sick leave policies and better sick leave policies performed any better over the last 8 months than the ones that didn't. Now, why is that? Well, I tend to think that this is a long-term signal. I think that companies that have better policies are going to attract, ultimately they're going to build stronger brands because they're going to have better people working there, and it's part of a kind of a longer cycle. And I also think that it's really difficult to tell based on the short run where you've got economic stimulus and PPP and industries being bailed out. It's very hard to separate the signal from the noise, you know, while we're in the midst of this pandemic. One interesting data point that did come out of it, actually, the only thing that was really that really jumped off the page is within the technology gig sectors, the companies that were yellow and green had on average, I think the mean performance was 21% positive between January 1 and I think the first week of August, whereas the ones that were red were minus 5%. So in a sector that has been on fire pretty much all year, that's pretty astounding. It's a pretty big swing in performance. And it's further confused by the fact that Apple actually is red. And I think one of the reasons, and so this needs to be unpacked further, right? But one of the reasons that may be is because they've got such a big retail presence. And as a result of that, they've got different sick leave policies for retail workers. So again, that's additional data. But, red companies are down 5%. Apple was up 30% over that same time frame. So there's with any data, the more you unpack it, I think the more you learn, and I think we're in that phase of this. But to me, I would have absolutely no problem incorporating sick leave into the composite picture that we try to develop so that we can invest in the companies that are being more progressive and helping our clients avoid the companies that are being less progressive or in fact regressive.
Thanks, Bill. That's interesting, and I guess the IT sector, where the paid sick leave policies are most prevalent, gives some indication that it's an important factor for that sector. So interesting that the ones in the red zone were underwater. Theresa, from your perspective, what's the investment rationale for considering the adequacy of a company's paid sick leave policies?
As I mentioned earlier, we are giving investors the choice of what to include or exclude in their investment universe. And then we're using a very sophisticated algorithm to build a portfolio that meets their financial objectives. So to us, enabling a client to identify sick leave as something that's important to them, and I think it should be, because I do believe that the best companies have the best policies. We also are using that, as I said, we will use it to inform our corporate actions going forward, because it's a very specific indicator that we can focus on. And then the third way we're using it, and this is extremely important, is in impact performance measurement. So we are at this point incorporating the data that Corporate Knights that you all provided to us into our impact performance measurement metrics. So that allows us to go back to a client and say, look, we told you that we could enable you to achieve your impact objectives. This is what your goal was, and this is what you've been able to achieve. And so impact performance measurement to us is just the proof statement from the impact perspective that we're doing what we say we're going to do. I mean, obviously on the financial performance side, we all know what numbers we're looking at. But impact performance is more difficult to measure. And the metrics that you've identified give us the opportunity to add to our basic needs score within that impact performance measurement framework.
I'd like to, if we're running up on the time, there's one more question that I'd like to ask, and there's some questions coming in. One question for you, Laura. Bill mentioned using the paid sick leave threshold of 10 days is a KPI. Can you just clarify, you went over some of this in your presentation, but there's, does this mean, that X percent of a company's workforce has paid sick leave, or can you just confirm what the parameters are, how this is specifically defined?
We chose to look at, basically the optimal would be to know it per rung of employees, but often that information is not available. So we basically looked at the lowest ranked employee. So we wanted to see how are the most vulnerable individuals or employees in the company being treated. So that was what we really took as if they get, for example, 7 days and the next level employees gets 10, we used 7. So we would say that would be basically the minimum number of days that anyone in the company can get as paid sick leave, if that's what you're asking.
Okay, so it's a sort of a cutoff threshold that applies to 100% of
exactly, that there's a minimum in the company that nobody gets under a certain number of days.
The last question on my side for Bill and Theresa, how do you see adequate sick leave becoming a new criterion for investment and investor-led advocacy?
So just in terms of advocacy, it gives us something to focus on. So I really do think that focusing on those companies that have 0 paid sick leave is a great starting point for putting together a list of companies where you can reach out to them and say, this is an area that we're focusing on. This report demonstrates that your sick leave policy is, I guess, lacking. I'm sure we would use a nicer word, but can we talk about this? Can we engage you on this? Is it something that we can get into a proxy, probably not for 2021, but beyond that, if necessary? Or will engagement efforts lead us to a favorable conclusion where that company increases its sick leave? So I think there are a lot of ways that this information can be used to directly drive certain types of corporate actions.
Just borrowing a lesson from the Paris Accord and atmospheric carbon, investors have enormous clout, right? So, if you look at the Climate Action 100 Plus initiative, which I think involves about 160 companies globally, if I'm not mistaken, there are now 450 global firms representing, I think, $45 trillion of investable assets that are actually leaning into 160 companies, half of which, by the way, have, I think roughly half of which have pledged to get to 0 carbon, have pledged to science-based targets, or have agreed to TCFD reporting. So when investors decide that something is important to them, they will get their way eventually, right? And so I think this is going to happen here because, and it's not necessarily going to be led by the investors, but really, Toby, all it takes is some well-placed research reports, frankly, that compare leaders and laggards in industry groups. And, it's an incredible sort of human phenomenon how people are fixated on how they stack up against their industry group peers. And it's very bad for business if you're in the bottom quartile and you're in a competitive industry and you're competing for talent. I mean, of course, the problem is that the talented people are going to get whatever sick leave they want, right? And so we're not really talking about the highly paid talented people. We're talking about the people who are kind of the lifeblood of a lot of businesses and organizations and essential workers and stuff like that. But, I think it's just a matter of greater spotlighting the companies who are doing this properly and the ones who aren't. And I think you will see companies will make changes on their own. Now, it is a little disheartening, Laura. One of the first things I noticed about this report is that left to their own devices, it's not clear that very many companies would be progressive at all, because most of the companies that have, green or yellow are because they operate in geographies where it's effectively mandated. And I think only like somewhere between 10 and 20% of companies are actually doing this stuff on their own. But I do think that spotlighting a company is a form of policing them that will be very, very effective around these issues.
Thank you, Bill and Theresa. And I think that's really useful for the audience and for us at Corporate Knights to reflect on. And I think often the power of investors goes so far beyond just the pure capital allocation impact and the capital price, supply and demand for shares. And it really goes to the heart of what the norms are in our society, the fundamental norms that influence the laws and the regulations and behaviors. And when investors start to speak up and to amplify research that shows the difference between leaders and laggards on important issues, it really makes it possible for things to accelerate and move so much more quickly than if investors are on the sidelines. So when we do this kind of research, we kind of see ourselves, this is sort of like a little pebble, this piece of research. And this is a piece of research we plan on updating annually and will be starting in 2021, incorporated into all of our global ratings with a 2.5% total weight, fixed weight. So this is a research that will happen each year. It's the first piece of research. We look forward to tracking the performance between the leaders and the laggards. And this research really doesn't, it's like, it's a pebble, but it doesn't really make any waves unless someone tosses it into the body of water in the capital markets. And so we're really grateful that both Bill, you and Theresa, you are through your sort of pioneering leadership outfits on the portfolio management and on the advisor organization side are taking this pebble and throwing it into the pond. And we can see it building ripples that can build up into mightier waves and move us to a situation where instead of just a third of companies having adequate paid sick leave policies for their basic employees, we can get that up to a more of a complete picture. And I think that would be much better for us as in the investment community, also better for companies and better for society, because we'll be more resilient and stronger. So with that, I'd just like to thank everybody for joining us today. The full report is at corporatenights.com. If you would like more information about the data sets, please get in touch with us at research@corporatenights.com. And we look forward to continuing the research. And thanks again, Bill and Theresa, for your great insights and for your general leadership in this space. And Laura, great job on the report. So thanks a lot, and over and out. Take care.
All right. Bye-bye.